So you have on the one hand liquidity as one of the main added value of tokenizing assets. At the same time, the actual liquidity on tokenized market is very fragmented because of the very nature of these markets and the tech that underpins it. And so putting the two together, we launched Keyrock with the idea of building a system that will allow us to provide liquidity to all digital assets, knowing that for us, our view is that all assets will eventually be digital.
Hello and welcome to another episode of RULEMATCH Spot On, the only podcast focused exclusively on the institutional crypto and digital asset industry. I'm your host, Ian Simpson, and if you want to know what banks, securities firms, trading firms, hedge funds, and others are doing in crypto and how they're doing it, this is the place for you. My guest today is Kevin de Patoul, CEO and co-founder of Keyrock, a leading global liquidity provider, market maker, algorithmic and OTC trading firm, founded 7 years ago, and he is our guest today in the studio in Zurich. Kevin, welcome.
Thank you, Ian.
Good. So today we're going to be talking about liquidity in crypto markets, all about liquidity. It's going to be really interesting to get your take on some things across different areas of the market, whether it's high-frequency trading, whether it's market depth, OTC trading, settlement, some of those things that are a little bit down in the weeds. But maybe just to start with, what would you say is the current state of liquidity in the market?
Well, I think that, thanks to our good work, it's getting better and better. But, very clearly, there's still a lot of work to do. I think that we are seeing in general liquidity that is improving, of course, on the main assets, but also to some extent, on the smaller asset, thanks to a lot of DeFi innovation that basically are very good to create that initial liquidity on assets that are more earlier in their life cycle, I would say. So I think that in general we're seeing clearly improvement. However, it's still in general, if you look at digital assets in general, it's still quite far from where traditional markets are, except for the most liquid pairs. I think there's also a tendency to underestimate how an asset like Bitcoin, how liquid it actually is, right? In terms of spread, we're talking, sometimes it's quoting in less than 1 BIP for pretty good size. So I think that on the bigger assets, clearly there is strong improvement in liquidity. There was 2 years ago following FTX kind of a big dip, also following the Alameda collapse, there was quite a big dip there with widening spread. This is something that has been tightening and getting better very clearly. So I think we're in a good place, but there's still some work to do. And
when we talk about liquidity, you mentioned DeFi, but then, so where is the liquidity? Geographically, but also venue types and that. You see that from a high level perspective, I'm sure.
I mean, there's still, Keyrock, we trade centralized, we trade decentralized, we trade on spot, we trade on derivatives. Clearly the bulk of the liquidity still is, in centralized exchange, mainly on perps. Clearly, if you look at, what is centralized versus decentralized, it's like 1 to 10, more or less in terms of ratio. So clearly it's still there. However, that is quite different, of course, when we talk about the long tail, because, it's very, very easy to launch a pool on a DEX, right? It's not that easy to get listed on a centralized exchange. So you have a bit of a different focus to some extent and different value add of both types of venue. When you look at geographies, there's a lot less in Europe than we would have in the US or Asia. We still see that clearly for us, the pricing is happening in Asia, very, very honestly, and the rest is a bit more following. If you look at most of the larger exchanges, there is a very strong concentration in Asia, very clearly. So if you look at the split between centralized, decentralized types of instruments between spot and perps, mainly options are still very, very, very small. And I do think it's a very big lever of growth in the future. I think there's going to be a lot of growth there, but currently it remains very small compared to the rest. And then geographically, as I say, Asia would be a bit more in the lead.
Liquidity is your thing, right? At Keyrock, that's what you focus on entirely. When we talk about what you do and how you do it, just give us kind of the high level of the different pillars of what you're doing, maybe how you started 7 years ago, right?
Exactly,
if I understand, and then how that's developed.
Sure, I can start with the beginning. So I founded the company with two co-founders in end of 2017, right? I've started to be interested in digital assets and Bitcoin in 2014, 2015, more and more. And basically back then with, ICO starting, the main question for us was, why are these so popular? Because ICOs back in the days is kind of a glorified Kickstarter campaign, right? But the size of ICOs versus crowdfunding, there was a very big an order of magnitude of difference. So the question was why. And what we saw is our hypothesis back then is, okay, if you're basically digitizing a crowdfunding coupon, and this makes it a more interesting asset because you have something that is potentially a lot more liquid, because you have something that is a lot easier to send around, to trade. So you have something, a lot of potential liquidity that comes with tokenizing assets. At the same time, the entire market was and still is based on a decentralized technology, sometimes not decentralized enough, but that's another debate. But in general, decentralized technology, which means that you have quite low barriers to entry. You have a lot of innovation because you have composability, of course, of those innovation as well. So you have liquidity that is extremely fragmented, right? And so it's really putting those two facts together that led us to create Keyrock. So you have on the one hand liquidity as one of the main added value of tokenizing assets. At the same time, the actual liquidity on tokenized market is very fragmented because of the very nature of these markets and the tech that underpins it. And so putting the two together, we launched Keyrock with the idea of building a system that will allow us to provide liquidity to all digital assets, knowing that for us, our view is that all assets will eventually be digital. When we look at crypto today, what it is, it's a proof of concept. It's okay. This is kind of the cutting edge, showing what we can do when we represent value in a fully digital way. Whether the value being represented actually has value, that's another debate. Many things are digitized and, in my view, don't have a lot of intrinsic value, but still it makes sense and it shows a proof of concept of what can happen when you digitize value. So eventually we believe that this will encompass all assets, and that's kind of where we got started. So building a system that allows us to provide liquidity to all digital assets. And that's nice, as a end goal. The question is, where do you begin? And we've decided at the beginning, we start as a market maker. So really making markets not as a prop shop. So Keyrock, the core of our DNA is not to be just a prop shop. It's really as a service provider. So we start as a market maker, working with token issuers, working with exchanges as well, to be a dedicated market maker, to be there, providing service level agreements, providing a lot of transparency, showing them that indeed we are providing the service that we are selling you, and really acting as a service provider. And that is something that I always emphasize on, because the core of what we do is to, building a client franchise, building long-term relationship and collaboration with our clients, and not just a prop shop that does a bit of service on the side to source cheap capital. That's simply not who we are. So we really started with market making as a service. Initially, this allowed us to widen the horizon of our trading horizon, both in terms of the assets that we're trading, but also our connectivity to centralized exchange, decentralized exchange, spot, perps, derivatives eventually as well, and being sure that we cover a big chunk of the market and focusing on market making as a service only for the first, I think, 4.5 years of the business. We got to a point where we're very satisfied with our pricing, our execution capabilities, and so let's make sure that others can benefit from that pricing as well. And so we started more on our OTC activities on the spot, but also on the option side, with the options being our option desk. We launched it in January this year, so that came a bit later. But that's basically where we started, and how we've been evolving over the last almost 7 years now.
So really coming from the crypto side, and now it's bigger and the services are broadening out. When we focus just on the market making side, there's some, and I'll mention the name Flow Traders, which has been big in traditional assets, got into crypto as well. I asked them the question how their strategies maybe mirror or don't mirror what they do in TradFi. Do you feel like you are getting closer to TradFi with your market making strategies as things become more liquid and more popular, or how is that developing?
I mean, it's tough for me to answer because I never traded in TradFi.
Okay.
So of course we have lots of people in the company that come from traditional finance. But so there are some things that are getting closer in terms of liquidity. There are some different things that are remain very different when you look at the fragmentation of the market. When you look at the the technical immaturity, also of part of the market. So you need to build into your pricing a lot more resiliency, a lot more redundancy than you ever need, than you would ever need in traditional finance. So for something there is some convergence on some of the topic, but I do think that inherently the markets are very different. The way you trade, the capital efficiency that comes with speed of transfer, but the capital inefficiency that comes with the lack of credit lines many times across the industry, the fragmentation of the pricing, the fragmentation of the liquidity, the technical immaturity, all of this means that fundamentally there are still some very different ways of trading, of pricing and executing, even though in general, like as the market grows, there starts to be more and more similarities, mainly I guess with the forex market. There are some similarities there, but I do think that they remain like the technical differences in the assets mean that you end up trading in a very different way.
Just on the technical side, and not on the technical sides of the assets themselves, but how you serve as the market maker. Centralized exchanges, we know in crypto came out of the retail space,
yes.
Not necessarily for institutions. So connectivity and some of those down in the weed technical things had to be developed over time. How have you built out your technical capabilities and what you do to serve clients?
Yeah, I mean, it's been a painful journey. Like I say, we've integrated more than 90 exchanges, 90. So no standards.
Yeah.
Starting to be some standard, more and more kind of fixed connectivity in the industry as well. But I mean, it's been tough, and that's where I think it's not the same thing as building one very good connection to one pricing venue in TradFi. It is different because there's a geographical, difference on where all those exchanges are. There's a difference in speed, between each of them, even though they will be trading the same assets, potentially giving, very different prices for those assets. There are differences in the tech. How often the tech fails, because it does happen. Something that you would never expect in a million year to happen on a TradFi exchange happens in crypto. And all of this has to be, built into it, that the resilience that I was mentioning in our systems, and also in the way that you price, it needs to take into account a certain buffer and a certain expectation of failures. And that's been a lot of investment. That's been, sometimes frustrating, but at the end, I do believe it creates some kind of a moat as well, because being able to do that now is potentially a lot harder than it was, when we started 6 years ago. And so yeah, it does create some challenges, but that's why there are opportunities as well.
Probably the barriers for entry to market making in crypto, and then the next level of digital assets is much higher today than it was.
I would think so.
When
Definitely,
you started.
yes. Yeah. Definitely.
Yeah. When we talk about technical connections and those things, standards aren't quite there yet. Do you work with others to kind of get to those standards, or what do you do?
We work with every single one of our counterparty, telling them what the benchmark of quality is in our eyes, and what is of the entire horizon that we trade, what we see as the best, what constitutes the best, what our needs are, and hopefully, as somewhat valuable customers, we are able to push that in the right direction. So we are working with them, but in the end, of course, we're not the marketplace. We work with marketplaces, but it's in their hands to make it as best as it can be, and we're trying to influence that as much as possible by using the width of our horizon as a learning opportunity, and we're showing this is the best that we see. Please, can you do the same? Because that's what is eventually going to attract more volume to your venue and make sure that we continue to trade here, is because you get to a certain level of quality. So
give and take. I mean, you telling them a little bit what you would like them to do, and them telling you what they can do. And
exactly.
That grows. You've grown to, is it 180 employees now? That's
a bit less than that, but almost.
So a lot of those technical people to build it out.
That's more than half the companies. Yeah,
amazing. Okay, let's just dive down into trading itself, and from a high level. Well, first of all, some people say, maybe coming from TradFi, crypto isn't liquid. It's, and you mentioned the fragmented liquidity, so that's one challenge. But now let's talk about the biggest trading firms in the world coming into the space and starting to do business. If they come with these really large orders, and they hit the market, crypto being as big and global as it is. How does that filter through the market, from the market makers that get hit across different venues, then maybe through brokers where the or smart order routers where the trades are split up, to then the hedging. Just what is the ripple effect or the radius of something like that? Is that still a challenge?
A challenge. I mean, it depends on what size, right?
Sure.
So of course, the bigger it gets, the more first, the more counterparties will need to be involved, and then you're going to have. If you look at a very good example is recently all the ETFs, right, and how much they've grown since the launch, the impact that it had on price. If the market was super illiquid with such a big buying pressure, you would have expected everything went 10x. Not the case, right? So there is some liquidity there clearly. They are not this buying pressure on ETFs. It doesn't just be dumped on books, on central limit order books, right? It does go through liquidity providers initially, and that's where there is a lot of volume there. But then, of course, these liquidity providers, they can, and Keyrock amongst them, we're going to be deciding whether we warehouse the risk for a certain amount of time or not, whether that risk can be offset by other flow that we have coming from other clients, and then partially be hedged as well on exchanges, down the line. So there is kind of that ripple effect. When I look at the liquidity now, I think that the ETFs are a good use case to see that there is still some quite deep liquidity to be able to withstand these unilateral pressure as we've seen since January in general. And so you have kind of that split between first OTC and then eventually with some crossing of flows, and then eventually going to the exchanges themselves. Yeah.
Was Keyrock itself involved in the ETFs in market making?
We are, yeah.
Yeah. And are you at liberty to say more about that?
No.
And how? No, okay.
No.
Maybe can you say more about how you prepared for that, or just what were some of the considerations when it was clear that this was going to come? Was there anything special that you worked on?
Of course, there isn't kind of one specific preparation. It's more kind of it's a journey, right? You need to make sure that
checklist of things
that you need to do well. But even before the ETFs were a possibility, it was about you need to be in the game, right? So are you able to quote a type price? Are you able to facilitate size, like trades at size? And are you able to do both, all of the above while maintaining, a full regulatory compliance and making sure that you do things well too? And basically that's something that takes years, and that is, an continuous effort rather than, the ETFs are going to be in 5 months. Let's scramble to be able to do it, right? It's really kind of just a continuity of our strategy since the beginning. So
So building the reputation, building the tools over time to be in that position. Just on the topic of the ETFs, I think there was some research from Keyrock recently about the weekday versus weekend liquidity. Can you say something about that? Is that a trend that you've noticed and something that you have to take into consideration now that the ETFs are there?
I mean, it's not only ETFs. Like we've always seen that there's less liquidity on the weekends. Like it's not something. I mean, I haven't seen the research by Keyrock, and maybe it shows that this is even strengthened that trend, right? But that was the case before, ETFs as well. We would see always like more volatility on weekends because you have less liquidity. And I mean, as much as like crypto in and of itself is 24/7, yes, but there are some very clear ties to the traditional world as well. There is some ties to fiat as well, which is closed on the weekend, and some people love to trade 24/7, others like to do something else. So we've always seen less liquidity and more volatility during the weekends. I would imagine, of course, the ETFs is kind of a traditional wrapper around Bitcoin in the case of the Bitcoin ETF. So I would imagine it just strengthened those trends because it just brings it closer to how the traditional market works. To some extent, this might be a bit of a step backwards. I do think that ETFs are great as a go-to-market, but as a product, they make no sense. Like an ETF on Bitcoin, I think makes no sense at all as an instrument. But it's a nice as a distribution. It's great. Bringing it to mainstream, it's great. So for all of that, I think it's a net positive. But in terms of certain liquidity habits and weekdays versus weekends, it does brings it closer to how traditional finance works.
And then back tied to fiat itself, whereas in crypto we also have large volumes of crypto versus stablecoin.
Yes, exactly. But I mean, still there, like, of course, this provides like all the stablecoins provide an additional buffer to like separate crypto from fiat. But at the end of the day, it is fiat backed, right? So you still have that link at some point. So when something happens there on the weekend, it's more problematic than on the week. I mean, you know, Silicon Valley Bank, stuff like that. There's still that component of, there is ties to the traditional system that does work 5 days a week.
When we talk, you mentioned the OTC and also your OTC desk that you've launched, and now market models again. Crypto starting with retail central limit order book type centralized exchanges. Then you have DEXs. Then there's OTC. What do you think is kind of the state of play in different market models right now, and where do you think potentially it goes in the next medium term, say?
I mean, I still believe, you know, that central limit order books are a very efficient system. And what is interesting is that there is, you know, the problem for some of centralization is like, how can we go around centralization? And so that's where, you know, we started to have more and more of, you know, 4 years ago, those AMMs, right? So, okay, here we add decentralization, but then the problem is that to do that, given the technical capabilities 4 years ago, we need to not do just a central limit order book and go with these pools. But then if you look at the subsequent kind of upgrades, they get closer and closer. Like the more ranges you add to those pools, the closer you get to an actual central limit order book eventually, right? So in terms of price discovery mechanism, I think a central limit order book works very, very well, honestly. And then yes, you may want to add, you know, some decentralized component to it for, you know, for different reasons and purposes. For some of which it makes sense, some others it doesn't. But I do think that it's a very efficient price discovery mechanism. One thing that we follow very closely on the market, especially on centralized, on CeFi, it's quite straightforward, right? But on DeFi, I think that everything around intense kind of on-chain RFQ system is something that I think is very interesting, and to some extent brings a lot of DeFi closer to what you would see in traditional market, but just with an additional layer of decentralization, which is good. Like you get a certain certainty and potential transparency around execution and how the trades are made, but also making it more accessible to a wider number, which is also a big chunk of the purpose of, you know, decentralizing finance in general. So like intent market is something that, you know, on DeFi we follow very closely, and I personally think has a lot of momentum.
And you're building to integrate and work with that also,
of course, yeah.
At Keyrock.
Yeah.
Always at the forefront.
Trying to be. Yeah.
That's good.
I think, you know, that this point I think is a very big differentiator between digital finance and traditional finance. The speed of innovation is absolutely ridiculous, because if you have a market that is, not everything is open source, right? But you have a market that is decentralized, you have a lot of composability, everybody's building on top of one another everywhere in the world. The speed at which things move is just absolutely ridiculous. And so for us, like we're a crypto native firm, right? But still it takes a very conscious effort and the actual allocation of resources, dedicated resources, to make sure that we continue, you know, to be at the edge and we continue to follow, because the speed of innovation is absolutely crazy. And I do think that for, you know, trading firms coming from the equity market, that would be quite a shock to see how fast things move and change, and there's a new financial primitive that emerges there, and then all of a sudden there's like hundreds of millions going there, and then now it's somewhere else, and like the speed at which that goes is
it's a little bit confusing, a little bit
can be,
makes your head spin, I can imagine.
But I think I think that comes with something new, right? If you at the end, as an industry, we're trying to somewhat rebuild market infrastructure from scratch in a different paradigm, like hopefully, right? That's kind of the goal. When you do that, for sure, there's going to be, you know, you cannot go in a straight line to the goal, right? There's going to be some back and forth, left, right, but that means a lot of new things. And if you have that in a way that is decentralized, the speed at which it goes is really impressive.
When we talk about institutions particularly, and that's also a little bit the focus of the podcast, and for us, thinking about operating, like you say, in those markets that are so new and changing all the time, do you think they come in and look for things they're used to, like the central limit order book? They would come and look for that, or maybe an RFQ model where, you know, OTC, you can be sure of your counterparties. That's also something that's big for institutions. What do you see being more advantageous for those kinds of market participants?
I mean, I think they definitely look for what looks familiar. I mean, why do we have an ETF? Right?
Yeah,
because
fair point.
it's just because it's familiar. It's the same thing, and it can be distributed in the same channel. So like nobody, especially not from for an economic purpose, you don't look for change for the sake of change, right? It's just like you I guess as an entity, as an organization, you accept to go through change because the added value that it brings is so high that I'm going to take all the hassle of changing things. But in general, if you can have that added value with something that looks and feels like something you've done 100 times before, you're going to do that just because it's a lot easier. It's a lot easier to explain. It's a lot easier to understand the risks. So for sure, they're going to look for things that look familiar. Of course, what we need to strive to is to bring so much added value with change that change becomes palatable and becomes, unavoidable, and that's how we move forward. But they would always look for things that look what they know.
And on the OTC side, do you see institutions going that route for the certainty of execution, of counterparty risk? What do you see?
I think that plays a big role. I think that one. Like on the OTC side, like if you trade with Keyrock, you have the liquidity of our entire system. You have the pricing of our entire system. You go and on one venue, you have the liquidity of that venue. So, I mean, of course, so just that already is like, okay, there's a very, you give a very broad scope. So that's definitely something that makes sense. Also, you have a certain certainty of who you're trading with, what they do, what the track record is, what is their legal status, their regulatory status, how compliant are they, what is the check that they put on their customers, and so on, and their counterparties. So I think all of this is one of the reasons why OTC has gained momentum, and even more so after FTX in 2022. There has been the counterparty certainty is something that became much more of a theme. Credit risk is something that became a lot more of a theme, and so that continues to be the case, especially for institutions.
Now I'm going to throw in a word that maybe some people don't like, or maybe some people pretend to know and don't know. Depending on where they come from, there's this concept of best execution,
yes,
which I imagine is also important for institutions. First of all, how would you define that in the crypto sense? Is that something that
doesn't exist?
Doesn't exist, flat out. Yeah,
it doesn't exist. Like there's no. First of all, there's no regulatory framework around it today. Second, like the market is so fragmented that even if there was one, I don't see how it could be enforced, to be very honest. So it just doesn't exist. It's a game of trust now, and to some extent that's where reputation and brand in OTC has an impact. Is that your counterparties are going to trust, and the more transparent and the more you can prove it, the better. They're going to trust that you're giving them the best possible price with a margin on top, depending on what business model you're in. But today in crypto, there's nothing it's always principle to principle. There is no agency business in crypto. And part of the reason for that is that best execution is extremely hard, close to impossible to guarantee, right? So it remains in the big trustless world that, digital asset would like to create. On that front, it remains very much of a trust-based game. Yeah.
Just going back on the OTC side, when it comes to settlement, there's probably still a lack of standardization on that. How do you get set up for settlement on OTC trades?
What do you mean by how do we get set up?
I mean, how do your counterparty, or how do the people want to be settled? I mean,
very fast. Very
fast. So no upfront pre-funding, but very fast post. Post.
Like it's quite common for us with our OTC counterparty to settle in less than an hour. Okay. So it's very, very fast. It has
not
to be
instantaneous, atomic on the blockchain, but
for things that are for like OTC trading, it's not going to be just an atomic swap, but like selling in half an hour is it's quite a norm,
and in good size as well. Yeah. Good. One other term that came up in a conversation actually with Hidden Road a while back, transaction or trade cost analysis.
Yes.
Is that still something that's not out there being talked about or needed yet? Or
I mean, it's is it talked about enough? That's probably not, right? There's still a level of kind of maturity that is gained on all the counterparties that are active in the market. Should it be talked about more? Yes. I wonder as well if it's as relevant as on other markets given the volatility of this one, right? So there is a question there. But in general, I would think that again for us, as I say, we build very strong client relationship. That's the strength of Keyrock is the client relationship. That's so for us, providing full transparency of the execution that we provide and the costs that are associated with it is something that is part of a good service. And so I do think that in general the industry is going towards better and better service and fairer trading. So should it be talked about more? Yes, definitely. Yeah. And we've always been supportive of it.
Do you think it will eventually get into regulation at some point?
It's tough. I think it's interesting when you think about like the regulatory frameworks. They have been built over the last decades to basically address the shortcomings of technology, because the less technology you had in transacting, the more there was a need for people, for trust. You cannot just trust, right? So we're going to put rules, verification. And so all of this has been built to address certain shortcomings of the technology we didn't have 100 years ago, we didn't have 40 years ago. And that changed year over year over year, right? And now all of a sudden we have technology that allows us to do a lot more. And so potentially requires less pure regulatory controls, because some of those controls should be embedded in the product or the service that is provided. But so the question is how do we go about it? Do we simply try to adapt an existing framework at the margin, so have marginal changes to an existing framework for something that is meant to be radically different? Or do we start to rethink as, okay, wait, we have this regulatory framework. What is the purpose of that? The purpose of that is to ensure protection of consumers, of investors. Great. How do we reach the same goal, potentially with a different framework, given these new technological capabilities? And so for this, it is a question like, how are we going to do about this? Should it be something that is a purely externally imposed regulatory framework, or should it be the markets pushing towards technological solutions that allow you to have the same certainty without the need for that external control? And I do think that the right answer is somewhere in the middle, right? But I think that simply marginally adapting a legacy framework is not going to work. I think that believing, let's just trust the market, that's not going to work either. But so there needs to be something that is, in between.
So I imagine, as this develops, and of course we know in some places it's developing more and less, US versus Europe versus other jurisdictions, and people have their opinions about that. How are you at Keyrock kind of preparing for what is clearly coming in the regulatory sense and what may come in different ways?
It's very hard. It's very hard. But again, I think it's those type of challenges is what create the opportunities in the first place. If everything was clear on the tech side, everything was clear on the regulatory side, there wouldn't be the space to build new things. So, but it's very tough because it changes constantly. By the time something is on, it's outdated. I mean, look at MiCA. DeFi is not in MiCA. When you think about it, that's crazy, because we're talking about first, DeFi summer was 4.5 years ago. MiCA is going to be live in January 25, right? Not there. No mention of it whatsoever. And then, so of course, it's going to change. And that I'm just looking at Europe, right? Because that's where we are. But then you look at somewhere else, it's different. It's constantly changing. You look at jurisdictions that were forward-looking. All of a sudden, take a very hard stance. The US for the last 2 or 3 years has been absolutely ridiculous. Now OpenSea is getting sued as well. I mean, the things are changing so fast. This is a very big challenge because you don't have certainty of business. You don't have certainty of business in terms of where can you do what, but it also has an impact on who can you do it with, because it's not being discussed a lot, but like the challenges around having banking and financing partners for crypto companies is very, very tough, because all of a sudden you have something that changes on the regulatory side, and nobody wants to touch crypto anymore, and it is a very big part of our operational challenges as a firm. Basically, what we do now is that we have plan A, plan B, plan C, plan D, and that means time, that means cost, right? And it's, by the way, we said that the barriers to entry now would be a lot higher than 6 years ago. This is a big chunk of it, because if you want to have the right setup in place with multiple options, that's going to cost money every single time, and you need to be able to afford it and to do it. So it is this operational burden is part of the barrier to entry, which of course we can only hope for more clarity, more stability, but it's not there yet. So the only way we can prepare is that
you prepare for everything.
we have to have multiple plans, and when we consider a bad scenario, is not whether it happens, it's when it happens. And just to make sure that we prepare for it. And when it does happen, it's fine because we have redundancy. And that's really how we look at it.
You mentioned MiCA, so let's go down that rabbit hole just a little bit. Maybe first of all, this is for the European Union.
Yes.
Then the US is in its state as it is. We have Switzerland, which we're happy to talk about as well. But you see these different regional things developing. As a company that's globally active, do you see that might break things up or also provide opportunities within a region? Like, will liquidity centralize in Europe and in the United States and in Asia? Or will it still continue to be global, but global players like Keyrock will need to really adapt and expand?
I mean, that's a strategic choice, right? Do you want to be a global player with the costs and challenges that come with it, or do you want to be a fully focused local player with therefore a bigger, more of a limitation on the scale that you can get at? So that's a choice, and each company will need to decide. And we see, for example, on the the exchanges side, you have different strategies. Some are we only do one geography, but we do that super well. Others say, we want to be global. So you can have both. In general, I think that something like MiCA, it's incomplete, right? But in general, I think it's good, right? There are some shortcomings and lots of discussion around, stablecoins. What are the requirements there? Are they too tough, not tough enough? Like, mainly too tough generally is the consensus. So there are clearly something that can be done better, but at least it gives something. Like, it's okay for Europe. You have something that is clear that will need to be iterated on, and we need to deal with the the shortcomings in the short term. But at least it gives something that gives stability, that gives clarity. I mean, I'm all for having tough rules and tough rules that make sense and make sure that we abide by them. But they cannot change all the time and be different when you walk 100 meters. And that's a bit what creates challenges. So I do think that the jurisdictions that will have the more clarity and the more stability will eventually win the most on the global scene, clearly. And then what companies decide to do, whether to be in one or all, that's strategic choice for each.
And maybe those jurisdictions that have the clearest regulation, let's say Europe and Switzerland, then come closer and closer together, providing those bridges between the two.
That's why I'm in Switzerland. So
there you go. Exactly. When it comes to MiCA, I mean, thinking about the exchanges and liquidity in particular, because that's what we're talking about, global players who do want to be active in Europe and in other places, will they, for instance, have to split the order books and have a totally different system in different places? How do you think that will develop?
So I think you need to have some level of split, right? Definitely, because if you're active in one jurisdiction, you need to comply to that specific jurisdiction, and therefore the risk taking, the risk decision, the trading decision have to be taken, within that framework, which is part of the constraint. You need to make sure that you can mix that with a certain level of global efficiency as well. But I think that definitely the more scattered the market, the less efficient it is, and the less liquid it is. So it is something that that's why I'm saying that we need to have a certain jurisdiction that have that clarity and that stability, and that the bigger that jurisdiction, the better, because the more fragmentation you have, the less efficiency you have. So I do think that any subdivision and differences in frameworks will lead to fragmentation of liquidity, which eventually is negative for the market.
And is there, besides firms like Keyrock, are there other ways that liquidity might come back together, become more accessible, or is it DeFi? Is it something else? Is it prime brokers? What are the options?
I mean, I think there are many different options for different needs, right? I don't think that there is a single solution. I think that's, if you look at what are currently the constraint, like the biggest I guess the constraint in crypto versus in digital assets versus what you have in TradFi is the capital efficiency. It's even worse in DeFi, right? It's very, very bad. So there's lots of solution workings towards that. So clearly, prime brokers, in the centralized part of digital asset, they can play a very big role. But that's not gonna help the retail participants, right? So I think that there isn't one single solution, but we're gonna have multiple that act as bridges, and our purpose as a market maker is to be part of that solution and provide liquidity wherever we see demand on the market.
Is there anything else about MiCA, and I just throw this out, you can answer or you don't have to answer, that scares you in particular, or that you think is really bad?
No, I mean, I think it's incomplete, right? I think that for stablecoin, for example, I think that some of the requirements are so strict that it kind of dilutes the actual added value of stablecoin to some extent, because it ties them too closely to some the traditional system as well. So I think there are some stuff that are not perfect. Something that is very bad and scares me, not really. One thing that I'm keen to see is how the actual regulatory arbitrage is going to work as of January between the different European jurisdictions, because the question is where, if you're active in Europe, where are you going to apply? Which jurisdiction is going to be ready to actually, process an application, ask the right and the smart questions, and actually be able to oversee activities? That we'll see, right? Because Europe is relatively, it's not that big, but there are many different regulators there, and how is that going to play out? I wonder. So does it scare me? Not really, but it is
a question mark.
A question mark, yeah.
Do you have a feeling, and not to put you on the spot, but one or two jurisdictions that are perhaps ahead or
I think
more
France.
advanced?
I think France is ahead. Yeah. I think they've been very proactive. Like unlike many, there are others, right? But I think that France have been very proactive with the Loi Pacte already a few years ago. They decided to be ahead of Europe. They decided to be ahead of AMLD5. They decided to be ahead of MiCA and launch their framework first. And there's a reason why we see like most of the large foreign players, when they come to Europe, they go to France. I do think that France is ahead. That doesn't mean that it's the one and only, right? But I think clearly they've taken a very forward-looking positioning.
And you said being here in Switzerland, that's a good thing. What is it particularly about Switzerland that is attractive for you, for Keyrock?
Well, I think things are very clear in Switzerland, right? They might not all be right, but they're very clear. And we find that the business environment is extremely pragmatic. If you have something that makes sense, if it's a bit different than what we used to, fair enough, it makes sense. So it's, what we used to has to change, so that this becomes a norm, because again, it makes sense. And so I think that this combination of clarity and pragmatism is something that is extremely conducive to business and innovation. So again, not perfect, but I do find as well, and I think that the dialogue between the regulator and the actual industry is a lot better than what I've seen in many other countries as well. Like there was like a few months ago this whole discussion around staking. How do we consider? There's been this back and forth. Things change again. You have clarity, you have pragmatism, and I think that's a very good combination.
Very good point. Very pragmatic and very, very open-minded, which we like to hear, and we like on many different levels. One topic that's not mentioned too much yet in the crypto space is high-frequency trading.
Yes.
I notice you have a job ad out for a head of engineering for HFT. What are you preparing for? What do you see? What do you think is coming up in that area?
It's interesting, right? Because we trade high frequency at the level of crypto, right? Digital
Which
assets
is not really.
It's not the same thing
HFT.
as what you have in TradFi, simply because, again, you have it's not kind of hardware based. A lot of it is cloud based, right? So and you have this fragmentation of the market, which just makes it a lot slower than you would when you have just one venue and one price feed. So I think it's going to it's just the nature of things to get faster and faster and faster and more efficient, and this is going to follow. But I think I don't think that a system that is as fragmented and as decentralized as digital asset will ever be as fast than a system that is 100% centralized. Maybe some engineers much smarter than me would maybe contradict me, but I don't think that if you look at the database, I don't see how a blockchain could be as fast as a centralized database. It has other strength, right? But it's never going to be as fast. So it's the same logic for this. You have a market that is a lot more fragmented, therefore is slower. But in its own benchmark, it's getting faster and faster. And so this is something that's going to continue, which I think is in the end positive for the market. Like the faster price adapts, right? It does benefit liquidity, and it is something that eventually is beneficial for most market participants. So.
And especially for people who are very good with the engineering, the algorithms, and so on,
that's part of it. Yes,
Keyrock. That's been something from the very beginning that you've been strong on. Yeah?
Yes, I mean, I think that when we were 15, we had 13 engineers. So and now it's more. Still continues to be more than half the company. So that's always been a very strong focus. Yeah.
And what else do you think will need to be in place to accelerate things, not just on the speed of trading, but on the speed of doing business in the market?
I mean, it's a
broad question. Sorry,
many things, right? I continue to be to think that the biggest bottleneck in the development of this market is regulatory clarity. I think that's what slows the whole thing down the most. And the reason why it slows things down the most is because we're trying to fit a square peg in a round hole, because we are trying to marginally adapt in a model that is decades old to something that is a completely different paradigm. And I think that's the biggest mistake, which is what slows the whole thing the most. So what I'm we're approaching Christmas. On my wish list will be regulatory clarity, so that we could get to something where now we have stability, we can really build things that make sense rather than
things that you won't have to change over time.
Exactly.
Every
because
month,
it creates ridiculous inefficiency if you want to be at a large scale, and it prohibits people that decide to be on a narrower scale to actually grow big. And so in general, I think it slows down the market a lot.
One question we ask everybody before we finish up is just, is there something in the market or something at Keyrock that you see coming up in the next maybe 6-9 months that nobody is talking about, or very few people are talking about, that our listeners, our viewers could perhaps look out for? And maybe we say not MiCA, so something else that could be interesting to think about or consider.
I mean, lots of things are interesting to think about and consider. Like, is there something that nobody is talking about that I don't have the arrogance
the crystal ball.
Yeah, no, but not even the arrogance to think that I'm that much of the edge of everything on the market, that I've seen something that nobody else is talking about. But I think that everything that is around intent markets and capital efficiency in DeFi is something that I think is extraordinary. It's extremely interesting. So, but there were presentations on intent markets 2 years ago at ECC, so it's not like nobody's talking about, but it is slightly gaining more and more momentum, and I think it's very interesting.
Very cool. Very good. Kevin, thank you very much for joining RULEMATCH Spot On. Hopefully we'll have a chance to talk again sometime in the future when there are some more developments and things to talk about. Thanks for joining.
Sure. Thank you very much for having me.